This conference will now be recorded.
So good afternoon and welcome to our 6th weekly webinar. My name is Marty Curtis, and on behalf of all the advisors at Provisions Wealth Planners, I'd like to welcome you again today to our webinar. As in recent weeks, we'll be having our guest speaker spend about 20 to 25 minutes, present his thoughts on the current market conditions and economy from their perspective, and then what investors might expect in the near term, looking into a crystal ball, looking out long term, what we might expect given, kind of things going on at this point. We have submitted a list of questions given the conversations that we've been having with our clients over this last week, and we have submitted them to be addressed either during comments or right after that, answer these specific questions. Then after that session, we'll again have time for questions and answers. And so we'll move on from there. Joining us today is Kurt Ryman. He is with BlackRock. As Managing Director, Kurt is a member of BlackRock Investment Institute and Senior Strategist for North America. In this role, Kurt contributes to the formation of BlackRock Investment Institute's tactical investment views and delivers the team's macroeconomic and financial market outlook to both investment professionals and the media throughout the US and Canada. So Kurt, thank you very much for spending time with us. I know that you have a lot of these on your agenda, and I'm just so glad and honored that we were able to get time for you to spend with our clients today. So welcome.
Thanks, Marty. It's my pleasure to join you, and thank you for the invitation. I thought what I would do is, I thought what I would do for the call today is walk through a bit of a, here's where we were before the coronavirus outbreak, and then maybe do a bit of a compare and contrast between the current situation and what we experienced 12 years ago with the financial crisis, because I think that's still fresh in everybody's mind. Give some signposts, and honestly, these are, like signposts driving through a snowstorm, right? So we have to be careful that we drive slowly and make sure we don't press on the brakes too hard. But the signposts are helpful, and I want to just go through 3 of those, and then share with you some of the things that we've been doing in our portfolios to try to get a better handle on where we should be allocated. Okay, so first off, and I hope I'm not being too redundant from the other presenters that you've had in recent weeks, but I would just really want to stress that this economic downturn, it's swift and severe. It's the steepest economic contraction in modern history, certainly greater than anything any of us has experienced. And the really important thing to just keep in mind is that this was engineered. This was a freezing of economic activity to avoid making a humanitarian crisis become a broader seizing of the financial system, and really intended to protect the most vulnerable and the people on the front lines, trying to help heal those who have contracted the virus. So it's more of a, if you have to put a frame around it, it's more like a global natural disaster than, it's not a business cycle recession, that's for sure. This is the standard business cycle playbook. We just need to throw that out. It doesn't apply here. And moreover, it's not a financial crisis. This is not something where there were incorrect assumptions that were brewing for years that suddenly led to things tipping over, like, for example, that technology internet companies should be able to survive without generating earnings, or that oil prices should remain at $100 a barrel for as far as the eye could see, or that subprime is never going to become a systemic issue, right? These were all the false assumptions that really undergirded all of the previous asset bubbles in the economy, at least the ones in recent memory. Today, we're seeing a steep fall in economic activity, but it was an economy that was in pretty decent shape. It was the late stages of a very, very long economic expansion, but people were still coming back into the job market, and wages were growing, and it at least seemed at the end of last year that all of the worries we had been having over trade were at least temporarily being put on the back burner. So I think about this economic decline is because it was engineered, and that policymakers really froze it in real time, as being very different. I think we could also maybe, I don't want to call it silver linings, but to the extent that the data is coming in and showing us just how steep, we'll get another reading on the number of people that newly registered for unemployment insurance. As of last week, the 4-week total had grown to over 20 million Americans. That's over 10% of the U.S. working age population, and we're probably going to get another 4 million more tomorrow. So it's clear that that this is bringing the economy to a standstill. But we can maybe say that the more that we can see the evidence that people are distancing from one another and sheltering in place, that this not only flattens the curve, but potentially does a good job of avoiding its further spread. So, in terms of contrasting the current slowdown with the one that was experienced back in 2008, I would say that this is, again, it's steep, it's sharp, it's faster than anything that we've seen, and it's faster than the financial crisis. But and it may have even be, over the next quarter or so, we may get twice as much or more of the slowing in the sort of 3 quarters from the time that the economy started to slow. The financial crisis, it was more insidious. It kind of came in slowly, but then it metastasized, and it became a much bigger problem. It was basically reversing a lot of the boost to growth that was occurring in the earlier years because of people flipping homes, and a lot of the housing market just was everywhere, building up growth in the economy. So when it came to a standstill, and there was obviously a lot of debt on the balance sheets of banks and households, that took a really long time to work off. And it turns out that in the, say, 3 years from 2007, the U.S. lost about 50% of its economic output compared to where it would have been. At a run rate going from 2007, it was 50% below where it would have otherwise gone had there not been a financial crisis. We're thinking that the cumulative impact to the economy is going to be much less, a fraction of that. But in order to get there, we've really got to see 3 things, and these are the signposts. One is the virus itself. The second is the bridge that policymakers are building, and then the third is just ensuring that what is a humanitarian crisis that's becoming an economic crisis doesn't turn into a full-scale financial system-wide crisis. So I would just say on the first, when it comes to the outbreak, I suppose we can take some signs of hope from the fact that China is now reopening its economy. They're sending children back to school. Children everywhere are people's most precious resource. So when the schools reopen, that tends to be a positive sign. South Korea has also gotten control over the virus, it seems. There's concerns about reinfection rates and growth in the virus once there is a return to work, but at least tentatively, it seems like they're having some success. Germany is another case in point where testing and tracing was done quickly and thoroughly, and they're now able to think about reopening their economy slowly. Georgia is going to be starting a return to work. Of course, we'll be interested in seeing how this evolves, but a plateauing in the number of new cases and a plateauing in the deaths each day. This is the kind of development that tends to, the markets anyway, the financial markets tend to view as a positive sign. It's not that the virus goes away entirely, but just once you can get a peak in the number of new cases, that tends to be a sign that things are beginning to get under control. And it's kind of, in a way, it's no surprise that this uplift in the stock market that we've seen over the past couple of weeks has occurred alongside the path of the pandemic in the United States evolving at a rate that has been less dire than some of the epidemiological forecasts that had been put in place by healthcare professionals and academic institutions. So, I can't say that we have the all clear, but it does seem as though the social distancing measures and the shelter in place and the quarantines and so on and the travel bans have really done a lot to do the work. The second signpost is just on the bridge that's being built, this massive and timely injection of government stimulus into the economy. It's hard to call it stimulus because it's not, this is not money that's intended to make the economy more productive or to grow the economy over time. This is intended to make sure that the gigantic loss in people's and companies' livelihoods is sustained over the period of the work outage. To have seen over $2 trillion, and it's approaching $3 trillion with some of the new spending that's working its way through Congress now. I mean, it took 5 months, and it only amounted to $700 to $800 billion of stimulus back during the financial crisis to finally get the assistance to the parts of the economy that were reeling. And of course, it wasn't. There's been a lot of criticism in the aftermath of those policies. Here again, I think that there will be implementation issues. There's going to be imperfect rollouts. There's going to be parts of the economy that were not addressed initially. So even though the size is just absolutely astounding, it's not going to be perfect. And so you're getting these measures here this week about topping up the payroll protection program, providing some additional relief to small and medium-sized businesses, getting money to assist the healthcare workers on the front lines. But all of this does help to limit two things that are really key here: the number of people that get basically detached from their employment, and secondly, the number of businesses that would end up filing for bankruptcy. There of course will be job losses, and there will be businesses that are hurt more than others. And when we talk about recovery, we should be thinking about a slower recovery for the energy sector, a much slower recovery for travel and tourism and hospitality. And perhaps on the flip side, there are sectors that we think probably are getting a bit of an accelerant to trends that were in place, like technology and social media and some communication services companies, healthcare companies. These all are seeing support to their business even now, and potentially would get over time quite a big shot in the arm. So it's important to think about the fact that this bridge is powerful. It helps us to at least look at the weakness in financial markets and think that some of those downside scenarios have been, that maybe those have been put aside, at least for the moment. And then I guess the third point, at least as signposts are concerned, is is on liquidity and the financial system itself. Here, it's just remember back a little less than a month ago when the measures were being put in place to shift trading floors into people's homes. That was happening at a time when people's fear about the virus was growing. There were not stimulus measures put in place. There were times when the corporate bond market was seizing up, and there were worries about commercial paper and money markets and all overnight lending that have, for the most part, been addressed with new facilities. The Fed has injected money into money markets, into commercial paper. They've set up facilities to purchase corporate bonds, municipal bonds, and they've also been big buyers of government bonds and mortgage-backed securities. There's more. I could go on, but just in the interest of time, I think that these measures have done a pretty good job so far of bringing some normalcy back into financial markets. And there's another really key component which is still yet to be rolled out, but it's this. There's $450 billion that the Treasury deposited with the Federal Reserve, and the Fed can use that to lend into the real economy. And there's a presumed loss of that money. A lot of these facilities are being treated more as grants or forgivable loans as opposed to lending, unlike the sort of injections in the financial crisis. There was some, I guess, assumption that the government would earn some money back on those investments that it made to help bail out industries. Here, I think there's more of an assumption that that there's a loss on some of the capital, and that some of the loans will be forgiven. The $454 billion that the Treasury deposited with the Fed could, if you assume a 10% loss, could be translated into or levered 10 times into over $4 trillion to be injected into the real economy. Lending that could end up being, I wouldn't necessarily say profitable, but really important for ensuring that that businesses remain solvent, and that it doesn't that a liquidity problem doesn't become a solvency issue, and then therefore the economy doesn't have the kind of extended propagated losses over time that would lead to a much deeper economic decline. So I think we can say that when it comes to liquidity and a bridge, we can check both of those boxes. When it comes to the virus itself, the social distancing measures are working, but because the U.S. is really far behind on testing and tracing, I think reopening in the economy is going to have to happen maybe a bit more slowly than other smaller countries that have gotten a handle on it quicker. As far as what we've been doing in our portfolios and thinking about how to adjust our allocations with all of this, and I have to admit it's not easy, but a few things stand out. First is, back in the deep dark days of the equity market sell-off in late March, we were concerned that we saw portfolios that were 60-40 stock bond go to 50-50 because of the deep declines in the equity market. And our view was that if people's objectives hadn't really changed, that they wanted to keep a neutral allocation to stocks and to credit. So we were advocating either adding cash or liquidating some bond positions to bring that equity position back to something closer to that benchmark allocation. It doesn't mean that we were overweight stocks. We just felt that there was a risk with stock prices having fallen as much to being basically underweight at this point. We've also been within stocks advocating a much more defensive stance. I know that there's probably at least an incentive when cyclical parts of the market get beaten up as much as they have to think about buying into energy or materials or industrials, because some of these companies have gotten their share prices have fallen quite dramatically. But with a lot of cyclical businesses, it's hard to know just how far their earnings have fallen. And if you don't have a good gauge on earnings, it's hard to say whether or not they're a good value or not. So what we've been focused on instead is companies that I mentioned before that have some of these structural advantages or that just are more defensive in nature, like healthcare, technology, the communication services sector, thinking telecoms, utilities, staples. These would be the sectors that either are more recession-proof or that just have these longer-run secular growth drivers that got a shot in the arm, because of the outbreak. I think most of us can think about getting more entertainment from home. We'll probably be using e-commerce more. I just opened, like a couple of weeks ago, I opened a stamps.com account, right? So going online, I think people are doing it in creative and innovative ways. And we've also become, much more adaptive and bigger users of social media. So that defensive stance or that sort of attention to quality within the portfolio has been pretty important for us. We've also been emphasizing sustainability as a way to rebuild that equity piece, because sustainable companies tend to exhibit operational excellence and tend to have more of a quality tilt to them. And when I say quality, I mean, higher cash flows, better ROEs, and more stable balance sheets. And then maybe lastly, I'll just touch on within fixed income, within the bond market, we recently overweighted credit, so meaning corporate bonds and high yield bonds. That was partly a reflection that the spread levels in both were already reflecting pretty dire outcomes for default rates. And because there's been this effort on the part of central banks and governments to provide stimulus, we felt that those default rate assumptions were too high. That's not true for energy. In the high yield energy sector, we feel that there's still there's quite a bit of concern there about default rates. So everything I say kind of X out the energy sector from that. But we liked the income, the fact that if you think about it, investment grade corporate bonds and high yield bonds are higher in the capital stack for companies, senior to equity. And this was also, thinking relative to equity, if you're looking for income, right now companies are facing difficult choices about their social license to operate. And that means that there's big questions on executive compensation, on paying out dividends, and on repurchasing shares, which has been a strong source of total return in the stock market that could be under pressure. So we felt like the income flow from credit was a bit more attractive than the income flow from stocks. And then the last point, which I'll make, is on government bonds. So it's not that you only have to be thinking that it's a good time to take risk. It could be that some of the securities that you own in the portfolio just aren't as attractive anymore, and government bonds really don't serve the same kind of purpose that they have. They've been pretty good diversifiers against risk. So, when we think about owning government bonds, oftentimes we have them in there. I mean, used to be for income. They don't pay much income anymore. They do tend to perform well when stocks get into trouble. So, and they have this year so far, and that's been good. But with 10-year U.S. government bond yields now below 75 basis points, I think that over a longer term holding period, we have to be worried about them just losing value from inflation. Probably we'll get some increase in interest rates from here, but since the Fed is buying all of the new issuance that the Treasury is putting out there, they're probably going to keep interest rates low. But I just don't think you're going to get a good return source from government bonds. In fact, I think it's going to be negative after inflation. And so, within fixed income, you might want to reallocate some of that government bond exposure to credit, not because you think this is all clear and everything looks great in the credit markets, but that the government bonds in the portfolio are almost a guaranteed way to lose money over time through higher inflation. So those are my initial thoughts. I hope I stayed within the time limits and left enough time for questions. So if it's okay, Marty, I'll pass it back over to you to walk us through the Q&A period.
Sure, thanks. There's a couple questions that came in and after I sent the email over to Tori to forward on to you this morning. So if we can touch on those. The first one is all about oil. This week we had the first time in history, quote, oil went to a negative 37 and change. So that's really not the price of oil, a barrel of oil. Can you speak to that a little bit and what that all means for us?
Yes, and this is, okay, when we talk about minus $37 a barrel close for oil, that was for the contract, the futures contract that expired in May, and that contract expired yesterday. Today we rolled, if you will, to the June contract. So this is oil that's produced in the U.S. that's delivered to refineries in Cushing, Oklahoma. That June contract is in positive territory, but it's seen its price come down quite a bit. Oil prices, as you know, have fallen, but as you say, Marty, the minus 37 didn't really reflect the true reading on crude prices. It just meant that if you had a barrel of oil to get it off your hands, you effectively, or if you had 1,000 barrels of oil, because that's how these are traded, you had to pay to get somebody to take it. And the reason for that is that you look at storage facilities and they're basically they're boiling over, right? They're at the brim, and that's a consequence of the fall in demand because of the coronavirus. Planes aren't flying, we're not driving, so there's been a steady fall in demand. I think most measures of transportation would say that we're utilizing the transportation fleet at about a 10% rate right now, relative to 100 before. I mean, this is an absolutely catastrophic decline in demand. But at the same time, I guess Saudi Arabia and Russia thought it would be a good idea to engage in a price war at the same time, and so they increased supply. And then once they finally got to an agreement to cut supply by nearly 10 million barrels a day, and that, by the way, doesn't even start to take effect until May 1st. The world is just awash in oil, and there's nowhere to put it. So a little bit the question on sort of the outlook for oil. Well, one of the reasons why we can say that this negative price on oil was technical is that most of the outer month futures prices for oil are, as I said, they're positive. As you go out 6 months to a year, they start looking a little bit more reasonable, right, in the 20s and 30s per barrel. But that's still way below where we were when we started the year. I mean, oil was trading at $60 a barrel at the beginning of the year, and now it's either around 10 or in the teens on the near month contract, and it's half that when you go out the curve. And so the point being is that when it comes to energy, a lot of the higher cost producers like the U.S. and the Alberta oil sands are likely to see a longer term structural decline, because we're not going to be getting back to work as normal. We'll be on these A/B teams, and that's going to mean less driving, fewer people commuting to work. We probably won't see a return to long haul flights until after there's a wide rollout of a vaccine or some sort of verifiable treatment that works without long-term consequences. So we should be thinking about the U.S. shale, North American shale, as being one of the big losers from the coronavirus demand shock. And I don't think we're not likely to see oil prices rebound substantially, even when we get into the return to work phase because the economy is just so oversupplied with oil right now.
Okay. So, I mean, certainly, 6 months, to a year, we've got problems with oil. Longer term, do you think that we'll be back to anything near what it was? And you know what, the last several years have not been good for oil, or are we just avoiding oil at this point from an investment standpoint?
Yeah. So here's the thing, right? In the U.S. right now, energy is less than 3% of the market cap of the S&P 500. So it's, yes, oil has fallen, and yes, the suppliers into that are experiencing a lot of pain. And I guess you maybe could say that the downstream companies are not experiencing as much pain, but there's still a lot of pain. I think the equity market U.S. equity market has been able to push higher throughout this decline in oil prices and the hit to the energy sector because it just doesn't make up that much of the index. It's teeny. So would I avoid energy? In a sense, we kind of already are. When an index is dominated by tech and healthcare and financials and on and on. I would actually, yes. I mean, I think it's not a good idea to be trying to call the bottom in oil prices. I don't think I wouldn't be advising investors to be looking at energy because it looks so cheap. We're in for a long period of earnings declines, dividend cuts, capex cuts, followed by bankruptcies, and then eventually these assets, if they're worth anything, will be bought up by some of the integrated oil companies, the large super majors. That's the pathway. Instead of trying to make a gain on the potential for a rebound in oil, I would rather be thinking about owning the companies that have the cash flow that is observable, that have the longer term healthy demand characteristics. And as I said before, that's going to be companies in the tech and healthcare and communication services and maybe even the consumer spaces, as opposed to cyclical commodity or industrial commodity companies.
Okay. So what is your outlook? Look in your crystal ball to the end of 2020. What do you think it looks like?
Well, this is self-interested as anybody, right? It will have evolved to a period where I think we still haven't gotten back to being comfortable with, large congregations and restaurants. I'm be really suspicious whether we've gotten to the point where we want to, go to stadium shows or large sporting events. As I said before, I think long haul flights are probably not in the cards, even if maybe some domestic air travel, shorter international flights may be coming back online. I do think the economy is in better shape by the end of the year. We're in the worst of it right now. The economic decline, the steepness. The risk is another lockdown because of a big breakout, a reemergence of the virus over time. I don't think we can exclude that from the base case as a risk, but I would say that by the end of this year, much of the economy will be restored, not fully, and it will probably involve that people who have been getting more comfortable working from home are going to be sharing time in the office with their coworkers at home or they're in the office in order to increase the distance between people until there's some real clearance that the healthcare system is able to is fully staffed, and there's the the medical equipment needed. But I think by the end of the year we'll be pretty close to that point.
Okay. Okay.
And by the way, as far as asset prices go, I would argue that asset prices, risk assets that have sold off, will start to rebound along with the improvement in the economy. But I do want to just distinguish between, some people have been asking, is it a V-shaped recovery or a U-shaped recovery? And I just want to be clear that it's not V-shaped in nature. If it's going to be V-shaped, it's going to be something that maybe a second grader draws a V, right? Where the the right side of the V is a little bit less of a slope, right? So it's going to be, it's not going to be there will be a snapback. That's only natural, but we'll still be feeling some depressed activity compared to the pre-crisis period, because it's going to take a while for us to get back to normal.
Okay. What do you think if, and we are hearing a little bit more about a second wave, this fall and that kind of thing. If that were to happen, what do you think that means for the markets?
Well, if that happens again, and there's another call to lock down economies, this is, I'm I'd rather pretend that wasn't an option. Can I do that? But no,
I think you've answered it.
Yeah, no, I know. So it's essentially we'll do this again, right? We'll do this all over again. But what I worry about is that this is really where, when we talk about the most vulnerable in the population, that's where I think we really have to be concerned, because this is as you've seen on the TV, this is hitting different parts of the population harder than others. And we knew coming into this that there was a large segment of the U.S. population that was going to be unable to stomach an unforeseen bill of, say, $500, right?
Yep.
So we knew that was a large share of the population. We've heard more about, and I think a lot of us are more sensitive to the idea of that there's been winners from technology and globalization, and that there have been and that much of the population has either not gained or lost out. And I think that's part of the when we think about another round of this, I think that the appetite for shutting down the economy because it really hits people's livelihoods, and it becomes that much more difficult for the government to then say, oh, again, we're gonna spend another $2 trillion or whatever it may take. And so as we think about the demands for reopening, it has to be calibrated, or at least considered, against this idea of a second wave, right? It would be much better to get it right the first time, perhaps endure a bit longer of a shelter in place and a quarantine to do whatever it takes to avoid that second wave. And I think we start to, not to be too dour here, but I just want to say that a second wave would make it much more difficult for policymakers to avoid this becoming a broader financial wave. So it would most likely have a bigger impact on bankruptcies and people being permanently dislocated from their jobs. So that's kind of the counter narrative to this idea that it's better to open everything up immediately, that the pain right now is too harsh, that it's not serving the economy. And we know, we've heard these voices. We have to think about the second wave potential and what that would mean. And I think it is a rather a rather dire outcome.
Yeah, we're based in Wisconsin, as you know, and over the weekend, in the last week or so, there have been several demonstrations saying, it's, you need to let us go back to work, and that's my worry. It's, we're going to go back too soon, and then, what if, that impacts the possibilities of the second wave and that kind of thing. So let's move on
Yeah.
from. What are, and to respect your time, I'll give you one more question, and then we'll open it up. So what are your thoughts on a resurgence of American-made goods?
I think the way, if I'm answering the question the right way, my suspicion is that there's going to be quite a bit of reshoring of economic activity, not just to the U.S., but I think a lot of countries are going to be considering this. Now, it may not be made in the USA. It may be made in Mexico and Canada, and then there will be some option of using NAFTA. I do think that there's a growing schism between the U.S. and China. I think that's where probably the question is based. I don't think we're thinking about made in the USA versus Canada. At least I would hope not. It's probably more on the order of we've had quite a bit of difficulty convincing China that they're not playing by the rules, and they've been rather stubborn and haven't reformed their economy, and if anything, are moving to a stance that is much more totalitarian. I would argue it's interesting, when we think about systems and whether they work or not. And of course, there's people who don't trust the Chinese data on the outbreak. The numbers they say are too low, but I think the arc of the outbreak is probably right, and that the epidemic is largely under control there. And it's interesting to see the U.S. and other developed countries implement, at least for a short period of time, large government programs, right, to aid the economy. To aid people, right? So we're at least for a period of time, our system of government right now is looking much more state-oriented, right, than it is, free market liberal ideals. But after this is over, we should be thinking, because companies where they saw in the tariff battle, they said our supply chains aren't dependable. They never should have thought that they were. I mean, there was kind of this idea that you build a supply chain and there's no risk involved at all, and that's never a good idea, to think that something is riskless. But I think companies were open to the idea that they needed more flexible supply chains, and that they probably gave it lip service. They didn't do much about it, but now when borders are closed and air travel is restricted, and they just effectively can't get their products to market because of that breakdown in international shipping, they're now going to do the job of having much more flexible supply chains, and ones that, when they bring them back to the U.S., I think are going to be much more robotic and autonomous, because robots don't get sick. Right. So I think that's probably, when we think about made in the USA, we shouldn't be thinking of it as a return of production to the U.S. that involves a lot more employment. That I would not agree with. But as far as local sourcing, and by the way, supply chains, it's not even just a company thing. I mean, when we think about, agriculture is so important, right, to the state of Wisconsin, and we're seeing crops being dumped because they can't get to market. We have to rethink that whole supply chain as well. That is something that, given the pandemic, has to be thought through, because there are other ways to get agricultural goods to market but we just don't have either the government's involvement to get it in an emergency, or there's ways to build out crops in a way that it's not just being done in a mass location, and then it's not then you have something like this happen, and people don't know how to deliver it. So there's I think there's probably a lot of rethinking going on, not just international supply chains, but also domestic supply chains around agriculture that will have to be reconsidered. And now, sort of now that we know what we're up against, if we want to be more prepared in the future, it might mean more local sourcing, smaller, more diffuse agricultural settings across the United States, and maybe some rethinking about the large conglomerate agricultural farming and so on.
Well, that's interesting. Huh. Good point. Okay, thank you. So at this point, Jess, if you'd open up the lines, I'd like to see if there's anybody in our audience that would like to pose a question to Kurt.
Big one?
I do have one.
Okay, Norm.
I'm doing a little bit of reading today, last night and this morning, and I see several opinions from economists and investors talking about a not a V recovery, but a W or a double W. And I look in the reading, they're saying that as we open, this thing's going to go back up. We got to shut her back down, and then it'll open up again this fall, and then the second wave. Are you hearing more of that?
There's been all kinds of letters or symbols that have been used to try to describe how this reopening is going to play out. We've been describing it more as a Nike swoosh as opposed to a V or a W. In some sectors, it's not even going to be, as I've talked about, some sectors are not even going to have the degree of upside of a Nike swoosh. But it's I think that's a pretty important question, and I don't think there's an easy answer. This is the difference between being an economist and being a scientist or an epidemiologist. What we know, and I did the back of the envelope calculation, is that in order to ensure that that we can reopen, not ensure, but lower the risk of reopening without a second wave, is that we have to have testing and tracing in the U.S. And the size of the problem, the size of the population is too high to be able right now to guarantee that even we reopen in mid-May that there won't be a second breakout. I did a back of the envelope calculation, and as of last week we were testing 200,000 people a day, and if you do the math, that means in a population of 330 million people, if you want to test everybody, it's going to take 4.5 years. So it's the testing and the tracing, so just knowing who saw who when and who could have given it to who, that's we're way too far behind on that to have any success in being able to say, yeah, this a second wave, the probability of another lockdown is low. I think we have to admit that we don't know. We're kind of flying blind here. And so reopening is happening with the full known risk that you get another wave of infection. It's done sort of assuming that the hospitals and the healthcare staff can handle a surge in incoming patients. I don't think that's a safe assumption right now, and it's why, as we've been talking about, it's probably especially in the areas of the U.S. and of the world that are experiencing, even though there's been a plateauing, there's still a high number of daily new cases. It would be better to wait and see those case numbers come down before getting the reopening to prevent the risk of a second wave. Germany can reopen more safely because they've done the testing and the tracing. The same thing is true of South Korea. The same is true for China. We have not, and the testing part has to be solved before you can reopen without the risk of a second wave.
Okay.
Thank you.
Anybody else have any questions that they'd like to pose at this time? Going once, going twice. Okay, well, Kurt, again, thank you very much for carving out some time for us. And thank you to everybody on the call for joining us today. And we look forward to having you on next week's call or webinar, in which we will feature the thoughts and insights from Nash Engineer. He is from Fidelity. The webinar will again be on Wednesday at 3 o'clock. And as always, we really appreciate the trust and confidence that you place in us, and we work hard each and every day to continue the great relationships that we have with our clients. Please reach out to your advisors if you have any other questions or comments, and look forward to sharing time with you again next week. Again, Kurt, thank you so much. And everybody stay well.
You too.
You're welcome. And talk to you next week. Goodbye.